Well, good morning, everyone, and welcome to our presentation, Housing Trends Where Opportunity Meets Affordability during National Financial Awareness Month. My name is Thea Chambers, and I'm the National Market Impact Manager with Atlantic Bay Mortgage Group, and thank you so much for joining us. It is my pleasure to introduce our speaker for today. Selma Hepp is the Chief Economist for CoreLogic, America's largest provider of advanced property and ownership information, analytics, and data-enabled services. Selma leads the economics team, which is responsible for analyzing, interpreting, and forecasting housing and economic trends in real estate, mortgage, and insurance. Selma frequently appears on local and national radio and television programs and has widely quoted in the Wall Street Journal, the New York Times, and many industry trade publications such as National Mortgage News and the Housing Wire. Selma has received the Housing Wire Women of Influence Award in 2022. And a fun fact about Miss Selma is she is an ODU graduate, and she is very excited to share with you today. Please feel free to add questions in our Q&A, and we will try to address those at the end of the presentation. So please, Atlantic Bay and all of our guests, let's welcome Miss Selma Hepp.
Hi, thank you. Thank you so much for the introduction, Thea. And I'm very excited, as Thea said, to be here, particularly given my background at ODU. I also lived, in Norfolk when I was at ODU, and then I also lived in Virginia Beach, and I lived in Chesapeake for a little while. So I'm very familiar with the area. But because we have a lot of slides and time goes by fast, so I'm going to dig right in. I'm going to start sharing my slides, and I'm going to go through my presentation, and then at the end, hopefully we'll have some time for questions. So let's start with where we are at. This is the outline of the topics that I'm going to talk about today. I have a little bit on the economic backdrop. We did see GDP numbers come in today. They were lower than expected, though I would say proceed with caution in a sense that usually we do get first quarter readings being much lower, and then they end up being revised down the road. So I wouldn't hang my hat on what the current today's GDP numbers showed. We still do continue to see very strong labor market. People are still getting jobs and very few layoffs out there. Consumers are still spending. They're actually spending quite a bit, to the point where the inflation pressures are very persistent. And it's been very hard to get that disinflation to the point where the Federal Reserve wants it and where we are likely to see any rate cuts. So overall, when you think of good, bad, and the ugly, I guess the good part of all of this is the economy continues to hum along. It's really strong. And we're really sort of able to, in many ways, orchestrate that soft landing that we were not sure that is going to happen. In fact, some are even worrying about reacceleration in the economy. In terms of the housing markets, mortgage rates are really governing what's happening in terms of the demand. They do remain elevated. They have picked up again the pace, and consumers are very responsive to that. So as soon as mortgage rates go up, we see pullback in demand. And so while the spring home buying season started off early this year on a positive note, I would say maybe it slowed down a little bit as a result of higher mortgage rates. So we are not seeing as much of an increase compared to where we were last year in terms of home sales activity as we were very much hoping for, especially after that December meeting by the Federal Reserve, where there was a lot of optimism for rates going forward, and particularly how it impacts the housing market. But still, the buyer demand does outpace the supply, so that's putting pressure on home prices. Supply at this point is showing some promising signs. We are certainly seeing increases in supply, particularly when we compare the levels to last year. The levels of new listings coming on market has been stronger than last year. We did bottom out last year, so we are crawling our way out of that bottom. Unfortunately, in many ways, we are still way behind levels that we had prior to the pandemic in many markets. Some markets are actually seeing quite a bit of inventory being added. So we'll go into those details in a moment. But the other thing long term, when we think about supply, we do have this phenomena of baby boomers aging out of the home ownership, which means that supply is going to improve as we move along, as we move through the rest of this decade and into the next decade. But at the moment, given this imbalance that continues between buyers and sellers, home prices are hitting new highs, and our forecast for the year is for another 4% increase in home prices overall for the year. Now, one question I get a lot is, how is it possible for home prices to continue to increase amid these high rates and affordability challenges? One thing is that those that are moving tend to be baby boomers. They do have a lot of cash, given that they may be selling home that they lived in for a very long time and cashing out of that home. They generally overall also are the wealthiest generation of all the other generations. And there continues to be, as a result, a lot of cash activity, but not just for baby boomers, also investors continue to be pretty active in the market. Okay, so just a little bit more on this economic fundamentals. Here we're looking at the PCE inflation, 12-month change, and the red area of the line is where that's the last mile that we need to get to that green line, which is the target 2% rate that the Federal Reserve wants to see. Now we are seeing stalling of inflation in recent months, and a lot of this has come from insurance costs. You may have experienced that yourself. It seems like everything from auto to homeowners insurance is increasing substantially, and in many ways is impacting some housing markets where insurance costs are a big issue. We do continue to have housing shortages, as I mentioned, and that is driving pressure on rents, and our single-family rent index from CoreLogic has shown again a month-over-month increase in rents, so that doesn't bode well for inflation. So we have some structural problems there that make it very hard for that red part of the line to come to the green line and really get to be more consistent, or give a Federal Reserve more a confidence in direction of disinflation. Now, I'll say that the Fed is still communicating the expected 50 basis point cut. Now, it may, there's a lot of chatter out there among in the financial markets that may not be the case. Let's see what the Federal Reserve says at the next meeting, because really, in my opinion, they have been doing exactly what they're saying. Markets tend to get ahead of themselves sometimes in interpreting those signals and saying something in the opposite. So when you think about what happened after the December meeting, markets were pricing in 7 cuts this year, and obviously nothing close to that is going to happen at this point, and we're only 3 months later or 4 months later. In terms of the GDP, just a quick update here. The orange bars is where the forecast is. The first 2% is what the first quarter was going to be. Now, as I mentioned, it came a little bit softer, not for reason that we want them. It's not because consumers are spending less, but it's due to inventories and import-export numbers. So it's not for the right reasons. But GDP or economic activity is slowing gradually, which is what we want. But it's still remaining in a positive territory, and actually very close to the 2% economic potential, which is something, if you draw that yellow line across a number of years of economic activity, you get on average about 2% growth in the US. Now, in terms of the delinquencies, I'll first mention mortgage delinquencies before I go into everything else, simply because that's been a concern, giving higher rates, borrowing rates, also concerns that people may not necessarily, some people didn't make it out of their forbearance programs. Inflation is making pressure on some consumers, particularly if they have fixed incomes. We're not yet seeing any increases in delinquency rates. If you look at the current to 30, that's that initial missed payments, it's still trending along some of the lowest levels we've had. A lot of consumers are being modified further and further. So eventually there may be a time when we'll see an increase in these delinquencies and eventual foreclosures. We're not seeing that yet at the moment. And if that happens, I do believe that it's a very small share of the market activity or overall active loans. Okay, so let's move to the mortgage markets. So we have slowing inflation, but and you know the Fed has suggested ending of their increase cycle, but which suggests the peak of mortgage rates is behind us. But let me just move right to the mortgage rates here. What is the issue? The issue is that that we don't know at this point when the Federal Reserve is going to start cutting. So naturally, that forecast for mortgage rates going forward is pretty uncertain. And so the purple area of the forecast portion here is pretty wide, meaning that there are wide range of expectations about what happens with mortgage rates. We're somewhere in the middle there. So with mortgage rates ending at about 6.8, now they're over 7 again at this point. They are expected to fall to some low 6% by the end of the year. Now that's under a presumption of not an acceleration in inflation. Now, we don't have acceleration at the moment. What we have is stalling of inflation. So hopefully we don't get to that acceleration and we continue to see disinflation. And so that would bring us to low 6% rate by the end of this year. Now, the other thing that's impacting mortgage rates at the moment is that uncertainty around what the Federal Reserve is going to do, the fact that we had elevated mortgage rates that are turning off investors in the mortgage market due to the prepayment risk is driving the spread between 10-year treasuries and mortgage rates. So mortgage rates actually increased significantly beyond where the 10-year treasuries are simply because of that uncertainty, and sort of remain there. That spread remains there. So the line here, the orange line, is the spread, and long run average is about 170 basis points, and we continue to be at that elevated spread closer to 250. Over the course of the last 6 months, we were actually in over 300 basis point territory. And there's been some indication that we initially had with slowing of inflation, that spread has come down, or at least communication confirming of the intention of not raising federal funds rate further. I think that's now at the moment biggest fear in the markets, is that the Federal Reserve will increase rates again. No, again, I'm confirming that they have not yet said that. It's just been a market sentiment given what inflation is doing. But again, I think all of this uncertainty is what's driving mortgage rates higher and the mortgage rate spread higher. So now we have originated quite a bit of loans. Well, maybe not as certainly not as during the pandemic, but we have originated a number of loans over the period between 2022 and 2023 that will have potential for refi once when mortgage rates do come down. So at this point, we have over 3 million loans that are originated at rates over 5.5%, and then about 1 million loans over 6.5%. Now, the majority of loans, the orange portion of the bars, is the mortgage loans originated before 2022, and you can see that a majority of them, still over 90% of them, are below 5% or 4.5%, and so that's that lock-in effect that we are struggling with at the moment, in terms of people not wanting to give that up and move elsewhere in case they were ready to move. The other thing is that lock-in varies quite a bit by a market. Because some markets over the last couple of years have seen more transactions, more sales, more turnover. Those are the markets that are in green here, states in green. and blue to some extent, whereas the lighter color markets is where there hasn't been a lot of transactions, so that lock-in average mortgage at the moment in the market is still relatively lower. So to contrast, here in California, we have a low average rate below 3.6%, where in Virginia, for example, that rate is between 3.7 and 3.8. So, maybe not as significant to an average buyer, but it does speak to one's willingness to give up the rate and just decide to make the next move. Okay, so let's see. The other thing that's holding people back in many ways, and especially in markets where there's a lot of accumulated equity, is the fact that they have a lot of accumulated equity and they're not willing necessarily to give up that equity and pay capital gains. So in markets, particularly look at on the western part of the U.S., where states are in red and orange, that's where average home equity for a per borrower with a mortgage is much higher, and it's leading to a stronger lock-in effect there as well as a result of that. The other flip side of this is that people who are leaving these markets do have a lot of equity, right? And are taking that cash to when they're moving to other markets. So I'm listing out the equity in the highest out-migration markets, because there are markets that continue to see a lot of people out-migrating from. They have, in excess of $700,000 or even over $1 million. So when they move, they have quite a bit of cash, even after paying capital gains, to spend on a home elsewhere. And that continues to put pressure on markets where they're moving to, which would be a lot of markets in Southeast, for example. Okay, the other thing, so I mentioned homeowners' equity remaining high, which is providing in many ways a buffer and a cushion to homeowners in case there is a recession, which at this point we're not talking about anymore, but throughout the most of the 2021, 2020, 2022, 2023, we're talking about recession and worrying about what happens with the consumer. But what we realized is that consumer was so not as exposed to those rates because they were simply locked in with their mortgage and potentially with their auto as well. But average equity at the moment is at about $300,000, which is 4 times higher than it was coming out of the great financial crisis. And the number of homes in negative equity at the moment is only about 2%. Again, this is the lowest that we've had in history of our data series, which started after the great financial crisis, when we actually had almost as much as a quarter of borrowers being underwater. And so if you do have markets that would potentially see some home price declines, which we have seen, and we'll get to prices in a moment, but there are markets, particularly Mountain West and some Texas markets, where you're seeing home price declines. The question is, what does it do to negative equity? And there's so few markets, and the number of homeowners that didn't come in with as we used to call skin in the game, or a larger down payment, is so small that it's not actually impacting negative equities nationally at this point. The other thing that these levels of equity are doing is that they're driving people to take out homes based on their equity. So while HELOCs themselves are down. So the two charts here are showing you in number of counts, and then in dollar volume, HELOCs and home equity closed lines. So those are just set loan seconds basically that people take on their homes. While HELOCs have come down, seconds have actually increased, and so that speaks to availability of home equity that people have, but also there's some fear around maybe that people are tapping into their equity out of necessity because of the inflation pressures. Some may be not being able to afford increase in insurance costs and property taxes that has been rising in some states. Okay, so let's move on to what's happening in the market in terms of the supply and demand. Now, we do know that we have significant affordability challenges, and they've been it's not a new thing in the housing market, and really it's been low interest rates over the last few years prior to the 2022 increases that really afforded people to be able to buy homes, and then mortgage rates surged, and we saw a monthly payment jump as a result as well. So we are at the moment looking at the highest rate typical mortgage payment, inflation adjusted for that matter, that we've had in a very long time. If you extend this data to 1980s, that's probably the last time we had inflation adjusted mortgage being really, really high. But with the expectation of mortgage rates eventually coming down, we'll see a little bit of a break there in the yellow portion of that orange bar. Though again, we because of the structural concerns between imbalance in supply and demand, that really the break in terms of the affordability is really, it's very far-fetched at this point. In terms of the home sales activity at this point, on the left-hand side, you're looking at weekly data, weekly pending home sales data, and each line represents a different year over the last few years. White line is current year 2024, and you can see how it compares to other years, previous years. And so what we're seeing at the moment is a slight jump. So you see white line being slightly above the gray line. Gray line is last year's number, so it's slightly above last year's line, but still nowhere near the levels that we had, at least when you think about 2019, which was the last sort of normal year. The orange line here, we're still notably way off that orange line. So while we are slowly normalizing, I would say this market is really trying to find its way to normalization in many ways. It's happening painfully slow. So pending home sales in more recent weeks have improved, though. When you look at the sales on the right-hand side, for March, they closed below last year's activity. Actually, last year's activity was exceptionally strong when you think about just how high mortgage rates were. We had this surge of activity as at one point mortgage rates came down and people started rushing in. We had a little bit of an opposite situation this time, where just as the spring home buying season was starting, we saw mortgage rates go up. In terms of the inventory, again, you're looking on the right-hand side at weekly new listings, yellow line above the blue line, which is 2023 year. So you're seeing some improvement there. You're seeing the white line being above the blue line, but again, notably below 2019, which in these charts is a yellow line. So we are really, slowly, threading our way up to that 2019 levels. We're still about 30 to 40% below where we were pre-pandemic. And actually these maps here show that really well. On the left-hand side, sorry, it's not well marked, but on the left-hand side, you're looking at number of new listings year to date compared to last year. So that's the left map. The right map is new listings year to date compared to 2019 levels. So on the first left-hand side, let's see what's going on there. The bluer areas are more areas with larger increases compared to last year, and you can see mostly those increases happening in areas in Southeast, particularly in Florida, a lot of it in Texas, North, Midwest, and California. In Virginia, we are still in a green area in our the Chesapeake Bay area. It's I'm trying to remember how Tidewater area, right? Is in green, which means that it's about a 10% increase from last year. Now switching to the right-hand side, again, these are comparisons to 2019 levels pre-pandemic. The darker blue areas were only areas that we saw increases. And again, these are markets in Southeast, markets in Florida, markets in Texas. And what stands out to me here is that these markets correlate very well with, well, in Texas, there's quite a bit of construction. In some of the Florida markets and Carolinas and Georgia, it's well, particularly in Florida, is a, to me, question of insurance, of lack of accessibility to insurance and cost insurance, particularly the Gulf Coast region that has been persistently harder hit by hurricanes and now by cost of insurance going up. But then the rest of the country, you look at areas in green and yellows, and yellow again, and Tidewater area too, where declines remain compared to 2019 levels, pretty large, much lower levels than 2019 levels. So more than a 35% decline. So we still have ways to go in terms of catching up with that inventory. So inventory, again, holding a lot of the home sales activity still back in many ways. Okay, I'm going to skip this slide because I just talked about that, and this is an older slide. Now, the other thing that I want to mention is home sales transactions, closed transactions, how they, again, differ across the country. And this is 2023 numbers versus 2019 numbers. And we're not at this point much different than that. But the green markets and very few orange markets is where we're seeing lesser declines or an increase, and blue markets is where home sales transactions remain much lower than 2019 levels. Again, it's very much a story of tale of two markets, where these markets with more locked in potential sellers, lesser supply, and then also more affordability challenges remain more locked in, or fewer transactions than in these other markets that have more affordability and transactions as a result. Now, our forecast for this coming year, the last red bars here are year 2023, 2024, 2025. So we do expect a home sales activity in 2024 to be about 5% higher than last year, and then 9% higher in 2025. This includes total home sales, not just MLS sales, but includes off MLS sales as well. And you can see that the numbers here are very gradually returning back to where they were pre-pandemic. So again, inventories here really holding a lot of activity back, in my opinion, much more so than affordability, because I think if we had more inventory, we would have more home sales at this point. And this actually point comes very obvious in this chart. When you're looking at availability of existing single-family homes available for sale, and then you compare them to new single-family homes for sale, which is the gray line, you can see that the yellow line is notably below where it was anywhere in a period prior to the pandemic. We're actually only at a fourth of a level that we were earlier, or a decade ago, whereas the gray line, which is new home sales available for sale, has been only so gradually increasing over the last decade, because it's taken so long for the new construction market to get healthy after what happened coming out of the great financial crisis. And it's only now producing about as many units as we were at the beginning of this millennium. So in many ways, it's the markets that have more new home sales available for sale that are really having most of the activity at this moment. Now, this chart is a bit of a history lesson. Both charts are data going back to 1960s, and the idea here is to give you a sense of where we are now compared to, very long history of a home housing market. On the left-hand side, it's a total home sales per number of households. So we're controlling for increase in population. Yellow line is, and the yellow line at this moment is at some of the lowest levels that we've seen outside of recessionary periods, for example, coming out of Great Financial Crisis or during the 1980s inflation crisis. So we are really at a really low levels of a turnover in the housing market, which tells me there is a lot of pent-up demand there, because people, and I'm sure you've heard this a lot, people, even if they want to move, they say, well, even if I wanted to move and give up my very low mortgage rate, where am I going to move when there's not that much inventory out there? And homes are so much more expensive at this point. The other chart is the number of new construction units per number of households again, and that too remains at historically very low levels compared to any period between 1960s and 2000, early 2000s, when we were building twice as many units, single family units, that we're building right now. So that, that is really, these two charts are really the two telling stories of what's going on with the housing market. And I think both are normalizing, but as you can tell, that we are at a really low levels, and we're trying to find our way out of that at this moment. Okay. The other thing that's, so a lot of what I'm trying to nail down here is how much demand we have out there in the market. So we talked about the turnover rates, lock-in effect. The other thing is that the young adults continue to be stuck in their parents' basements. So the share of young adults living with their parents still remains elevated. It has come down a little bit during the pandemic, but it's still twice at the level of previous generations. The other thing is we've had a lot of immigration over the last year in particular. So the gray line on the right-hand side is number of immigrants that come into the US, both illegal and legal immigrants, just total immigration. And it's averaged about 1.5 million. And over the last couple of years, we've had an additional 3 million over that 1.5 that we would have on average get per year. We had 3 million in the last couple of years. So we've had significantly more immigration, which adds to the housing demand. And as these people, get employed, or they start participating in the economy, you get that turning into the housing demand as well. So again, additional components of housing demand that we're going to see in the future. And then lastly, we are in this time of demographic fundamentals that are very favorable for housing demand, which is that a largest age cohort is still peaking in terms of the first-time home buying age. And at the same time, what we do have is that baby boomers, which is the green bars on the right-hand side of this chart, those are the baby boomers who are slowly aging out of the home ownership. And over the next 10-year period, we'll get about 10 million units coming on market as they age out. Again, this is 10 million units over 10 years. And in many ways, we are undersupplied anywhere from 4 to 8 million units, depend on whose estimates you're looking at. So that will help, but that fear of a silver tsunami that some are worried about, I don't think it's going to happen. I think what we're looking at is a slow tidal wave of those existing homes being available for sale over the 10-year period versus that tsunami fear. Let me just mention a couple of risks, because I imagine you are experiencing that, particularly given the low-lying flooding areas. I know when I lived in Norfolk, there was years when there was a lot of rain, that a lot of sidewalks would flood. And so we do have, in many markets, issue of insurance, and rising property insurance is affecting affordability in many ways. So on average, insurance has gone up, some $500 over the last decade, which doesn't sound a lot in itself, because that's the average national, right? But when you look at by market, which is the map on the right-hand side, in the numbers, you're looking what the average premium is per state, and then the color coding is the increase over the last couple of years by state. So areas in red are the areas with 40 to 70% increases in property insurance, and naturally that tends to be highest in Florida. There's other parts of the Gulf Coast as well, and then you have the Tornado Alley there from Texas going inward that saw also very large increases in insurance, and the other reason being here is that it's not just flooding that was the first one that we think of, but there is hailstorms, there's tornadoes, there's unfortunately number of catastrophic risks has increased substantially over the last few years, which is adding to that cost. In fact, I think let me just skip this. This just again talks about why insurance costs are going up, which is, one is inputs to insurance, which is services and trade services, so labor and goods. So all the materials going into the production of repairs for homes that are being destroyed. But the other reasons are outlined here. So we have population shifts that we have over the last couple of decades, which is that a lot of people are moving to areas that are relatively more exposed to some of these natural hazards. We have inflation, we have legal system in Florida in particular, where there's been a lot of property claims by that account for the largest share of lawsuits filed nationally. There's some changes being made there. You have regulations in many markets. You have failure to adapt to new risks, and so it's causing caps on property insurance, which is causing some companies to exit markets. So I'm sure you've heard a lot about this. I mean, news are just flooded with this stories at the moment. And the last thing is the reinsurance market, which at the moment has a perception that a risk is being inadequately priced in some homes. And so there is expectation that in some markets that have elevated exposure to risk that's not yet being priced into the homes is eventually going to get priced in, which may lead to some price declines in some areas. Now, which are those areas? Let's first go into what does that mean for homeowners. So imagine in some markets, if home prices do decline, what happens to existing homeowners' wealth or equity that they built in their homes. At the moment, fortunately, we do have a very low loan-to-value ratio nationally. So we are at about 43% of loan to value. So people do have a lot of home equity built into a home. And actually, among the mortgage borrowers, we have about $17 trillion that they have in their equity. Taking into account all homeowners, those that don't have mortgage anymore, that adds up to about $32 trillion. So that's a substantial financial buffers. So let's see what happens if home prices decline 10%. On the left-hand side, you're looking at this loan-to-value distribution. If they decline then 10%, you get about 2.7 borrowers going underwater with a mortgage, just with a mortgage. And then you get, with 20% decline, you get about 6% borrowers going underwater. But again, on the right-hand side, you can see how that distribution varies very much by state. And so the areas in red and orange are the markets where that risk is relatively higher. So we do know that there is a persistent exposure of flooding in Gulf Coast and other natural hazards along the Midwest, and there's also been relatively more originations with low down payment programs so that equity accumulation is not the same as in markets where you had a lot of down payments, a lot of cash and things like that. So that does make a difference. But unfortunately, markets also with highest level of negative equity, like one that usually stands out in all of this is Louisiana. You'll see also higher exposure to risk. Okay, so let me move on. And the other one is taxes. We've seen increase in taxes, and it's been about 28% increase nationally, national median property taxes. And so let's continue to home prices. I'm rushing here a little bit because I'm realizing I'm running out of time, and I have still a lot to cover. Okay, so talking about prices. So in light of all of this, what's been exceptionally interesting to see is the strength in home prices, right? And that again speaks to that equity and consumer strength. But even coming into this year, the white line on the left-hand side is 2024. These are monthly changes in home prices, and we can see that in February, home prices grew as much as they did last year in yellow line 2023, where home price appreciation in these early months of spring home buying season were much stronger than the gray line, and that's the average that we saw prior to the pandemic. So we do continue to see relatively more appreciation in spring home buying season still at this point, despite of rates and despite of affordability. And some of that, again, may be driven by cash sales. So result of that on the right-hand side is what our forecast for the year is, and that is for another about 4.3% increase in home prices. Now, it's interesting to see what that distribution is geographically. On the left-hand side is by state. In our most recent price report, the areas in darker red are the areas with relatively more home price appreciation on excess of 7% on a year-over-year basis. So you can see Virginia here being in one of those areas, along with other Midwest and Northeast areas. So we have seen relatively more appreciation in these areas at the tail end of the pandemic, given simply how much appreciation we had in other markets during the pandemic. So, you know, the blue markets in Midwest, Mountain West, and in Texas, for example, did see a lot of appreciation during the pandemic, right? And so now they're scaling back, or a lot of ways of resetting some of that appreciation. On the right-hand side, you're looking at and the title actually flipped. It's select metro areas where these are the largest markets, and we're looking at where largest appreciation is. By metro market, where we continue to see a lot of appreciation is Miami on the East Coast, and then San Diego on the West Coast. And so why Miami and San Diego? You have a lot of migration to these markets. And so migration is from folks from regions that are from markets that tend to have higher incomes and potentially more accumulation in equity. And that's being transferred to some of these markets that as a result see a lot of appreciation. Now, this map is showing you where home prices are currently compared at the moment compared to where they were in peak in 2022, in summer of 2022. And markets in red are markets that still haven't bounced back. And the markets actually that stand out here are markets in the Bay Area of California, that Mountain West region, and then Texas, particularly Austin, Texas, where some of that appreciation is still resetting, just given how strong appreciation was during the early days of the pandemic. And you can see that in Virginia markets, which is lighter green, home prices currently are about 5 to 10% above from where they were in peak in 2022. Okay, and then in terms of our forecast for appreciation by state over the course of the year, anywhere, again, the average is about 4%, and Virginia falls in that 4 to 6% increase range. Much less so in Texas and Louisiana. Again, I do think Louisiana in particular has struggled for a long time, given their loss of jobs because of the rigging earlier in the pandemic, persistent hurricanes, Gulf Coast region keeps getting pounded by these events, and as a result is less appreciation. And then a lot of construction in Texas, which is actually holding prices back, or making that market continually more affordable relative to some other markets. And then you have these randoms like South Dakota, for example, but more particularly Northeast and California, where we do anticipate a little bit more appreciation. California, because it is resetting back to from the declines that it saw in after 2022 coming into 2023. Okay, so I talked a little bit about mobility or migration. So we still have about a quarter of people that come into an area coming from other areas. And on the right-hand side, you're looking at top measures with largest gap between incomes of those coming in versus incomes of local residents. And with that gap going anywhere between 40 and 60%, you can see now how that would put pressure on markets in local markets that people are moving to. So, just for example, what would be a most closest market here? A lot of them are in Midwest. There's some in the West and also in the South, but a lot of the particularly Midwest markets where we've seen a lot of people, young adults, actually first-time home buyers coming from other markets, they have substantially higher incomes of 60+% than local residents. So that's been one of the big drivers behind home price appreciation in these markets. And the map here is basically showing you, where we are in terms of migration at the moment still. And so orange markets is where we have relatively more people, this is based on mortgage applications, where relatively more people are applying to move out of that metro than move in. Not that people are not coming in, it's just you have relatively more people moving out. The blue markets are markets where you have relatively more people applying to move into those markets than move out. And so you can see, well, one thing that first stands out to me is Virginia area, that other than Washington, D.C., you have a lot of blue dots. So on average, people are more likely to be applying to move into the area than move out of the area. But you also continue to have a lot of these blue dots across Southeast and South and Florida as well. And it's not, and then you have that, in some of the smaller markets outside these large what we call, I guess, still superstar cities such as New York, San Francisco, Boston, DC, LA. And it's not necessarily that people are moving, when they move, that they move very far away. In LA, the case is that the majority of them actually are moving to adjacent Riverside because that's the more affordable region. In New York, they're moving in areas of Pennsylvania and Connecticut, because that's where you can find single family homes and still, in case of New York and Pennsylvania, maybe find more affordable housing. But in case of Florida, you do have a lot of immigration. That's where you do have a lot of immigration from other states because it is still the top retirement market. And so my last slide here actually is a bit on this. What does that mean sort of long term, that we have a lot of migration to these markets that are more exposed to natural disasters? And when you look at on the left hand side, this is our growth indicator. Basically, it looks at parcels that are in any stage of development that property records data suggests is in one of the 6 stages of growth. And the darker blue areas where you have more parcels that are under new construction. And you can see that a lot of that, again, is in these markets that have relatively more exposure to natural hazards. A lot of markets are in Florida Nevada, a lot of markets are in Gulf Coast of Texas, and then a lot of markets are in Southern California and Arizona, Nevada, where, you know, maybe it's not necessarily the same type of risk, but, you know, when you think about Arizona, you have concerns around availability of water. So it's not necessarily, you know, climate change itself induced risk, but, you know, to some extent, well, loss of, you know, drought is a part of that as well. But it's a different. It could be different types of natural hazard that are a concern. So so on the right hand side, we have a climate risk analytics a platform that we've developed that sort of looks at these risks going forward in terms of anticipated changes coming from the climate risk. And so you can see the correlation between the markets where we are growing, continue to grow, and markets where that are going to be in the future more exposed to risk. So when one thinks about what happens to home prices going forward, you know, I would be a little bit concerned about these areas that have a relatively more exposure. So that's actually my last slide. So I'm going to stop here. I'm going to stop sharing, and I'm going to turn it back to Thea.
Thank you so much, Selma. So much amazing information that you shared with us. Goodness, we are super excited to do a deeper dive into that, you know, afterwards, and we just appreciate all of that. So we have a few more minutes left over for a couple of questions. So one of the first ones I wanted to start out with is, with the information we looked at today, is there a feeling of what the stable point or a more normalistic market should look like, and when do you think that might be?
So I think, again, I think we're moving in that direction. What's really hard to say is we've had so many events in the housing market history that threw these seasonal expectations out of whack. So when you think about what happened during the pandemic, right, and that appended all of the seasonality in terms of the housing market. So we're still trying to figure out in many ways what is a normal, what is a new normal. But when I think about when the market was last more normal, I think about a period between 2015 and 2019. I think, you know, we were still finding our ways out of the great financial crisis, but it was, I mean, I think that's reasonable to expect. So, you know, when does that happen? I think we're probably, you know, it's not going to be this year. I do hope it's going to be, you know, next year, but I think we are moving in that direction. So, you know, we're improving, and low mortgage rates are going to make all the difference in the world. I mean, I think when the mortgage rates, you know, really do come down, you'll see a total unfreezing of the market. So, you know, let's hope it happens by the end of this year.
Yeah, no, absolutely. Those are all great things to look forward to for sure in this market. So next, and you mentioned the silver tsunami. So do you predict that the silver tsunami generation will stay in their houses much longer than previous generations? And what percentage do you think that is?
Well, I do think we do know that baby boomers are staying longer. We do know that people in general, I mean, that's kind of what I was trying to point to, is that people are staying in their homes longer. So we do know that baby boomers are this, you know, they prefer to age in their own homes versus going to retirement homes. So they will stay put longer. It's very hard to, you know, again, we don't have a long enough history. We only have the previous generation, which is the silent generation, to make assumptions based on. And that generation did end up going to retirement homes. So we're in a whole new framework, right? So it's hard to tell, but we are seeing much slower rate of people leaving their homes and staying longer. So that's why I think that silver tsunami is not a tsunami, it's a tidal wave. It happens much slower. Mm-hmm.
No, thank you for that. So I'm glad we have a few more minutes. Well, I'll give you a few more questions. So how long do you think it'll take for a new home or new construction market to reach its equilibrium?
That's a great question. It's taken so long for it to get to the point where it is today. I mean, when you think about it, it's taken this entire decade, or basically coming out of 2012 when everything, you know, sort of was on the bottom in terms of new construction, it's taken this long. I think, I think the fact that we are so undersupplied is telling me that that trend is going to keep moving in the right direction. And so I think over the next year or so, when you look at the forecast for a single family new construction for next year, that's where I feel like you are, in fact, adding more. Overall, you're adding more to the supply. You end up increasing the supply overall. Where now you're just sort of still like filling a gap in a sense. And so I think as of next year, that's sort of my point where I think, yeah, we are seeing that, what is really equilibrium too at this point, that's kind of hard to determine because we don't even know how many homes we're short of. Everybody's has different estimate, particularly if you start thinking about affordability. But what we really need is more affordable homes, but those are not the units we're building. So, it's a very hard question. Even us economists don't know exactly what the right answer is.
You're just guessing. So, and we'll end with this question. So, is there any good news or some positive news that we can share with our first-time home buyers and some of our underserved markets? Is there anything positive we have to think about for them?
Yeah, I know it's very difficult for first-time home buyers. So the way I see it, and maybe I'm really being too optimistic, but I think the fact that we are seeing more inventory, the fact that the competition is not as heated as it was last year, I think speaks to better access for first-time home buyers. I think last year, just last year, but the whole pandemic, when you think about how impossible it was to get into a home if you were a first-time buyer, because all the cash, buyer, all the investors, investor activity is down as well. It's still elevated, but it's down. But I think the fact that the existing home buyers are sitting still makes it easier for first-time buyers to enter the market. So if there was any time, and if the more they wait, the more mortgage rates actually do come down, you'll get that competition intensifying again. So I think the best time to really enter the market is when nobody else is in the market, because what we do know for certain is that home prices will keep going up. We do know eventually, I think mortgage rates will normalize, and that will give them opportunity to refi. So let's take opportunity of this relatively more quieter time. Again, it's not even, but relatively, and make that move. When I bought my first home, the housing market was stale. It was stale, and the forecast for home price declines and did not happen.
No, I know. And it's honestly like during this kind of quiet time, this is the time to stay the course, get all your ducks in a row, get ready so that when it is time to, to make that move, they'll be in a great position, and hopefully everything will work out great for them. So no, we super appreciate everything that you shared with us today and for your time. We know that you are very busy sharing this news with everyone. But again, Selma, thank you so much for this amazing session. It has been really helpful to all of our guests and to our team, and super informative, and we truly appreciate you. If you all have any additional questions or would like to receive any more information regarding our Engaged Speaker Series, please feel free to reach out to abwebinars@atlanticbay.com. And again, Selma, thank you so much for your time today. Thank you to all of our guests for joining us. And we do have another summer series coming up. That'll be our kickoff of our summer series. And we will be having an economic forecast. And if somebody asked that in the chat, we'll be having an economic forecast at the end of June. So stay tuned for that information that we will be sharing from our webinar Engage series. And again, Selma, we appreciate you. Thank you to everyone who tuned in. And a copy of this recording will be shared within 3 to 5 business days to everyone who registered and or attended. So thank you again so much. Selma, we appreciate you, and everyone have an amazing day and a great rest of your week.
Thank you. Thanks so much.
Thank you so much.